Good morning, Chris, and thank you for taking the time today. So we've had a couple of questions from people and advisors and investors in our funds around some recent news in China, and we're just going to run through a couple of questions this morning, and thank you for taking the time. So first question is, so recently there's been some news about the education stocks in China. Do you want to take us through what happened and what does that mean for other Chinese companies?
Yeah, thanks, Matt. A couple of weeks ago, Chinese government issued some regulatory measures around the private education sector in China as a way to limit that sector and the companies involved in it. Included in those measures were some pretty onerous restrictions, including mandating that those companies convert from for-profit operations to not-for-profits, but also importantly that they're no longer listed on foreign exchanges and they no longer receive capital from foreign capital providers. But you've got to step back and sort of understand the context and why that happened. And it's essentially a sector that was profiting from the financial hardships of the middle class in China. Okay, and so the Chinese government has ambitions and plans to have a stable, sustainable society, and also to develop the economy and reduce income inequality within the economy. And the great equalizer there has actually always been education. And so everybody's free to go to school and to take the entrance exams into college, and that'll lead to better jobs and better standard of living. Except over the years, a lot of money's been thrown at additional tutoring by parents who can afford it, and to the point where the private education sector is now just as big as the public education sector, and that leaves the masses and the middle class behind. And there's some astounding examples where the average income in China is about $10,000 a year, and often families are pulling together to spend $18,000 a year between schools and private education, private tutoring after school, and that's creating a lot of financial distress and financial hardship. It's also creating an emotional burden on the students, and really, at the end of the day, this sector was profiting off those financial stresses, which are counterproductive to what the Chinese Communist Party and the Chinese government want to achieve for the country. And so it was really a targeted effort around one particular sector that was running counter to the CCP's ambitions and plans.
Okay, great. So there's also been some selling pressure on Tencent and Alibaba that we own in the portfolio. What do you think that's going on there? And are you still as convicted as you have been previously in those names?
Yeah. Well, so the short answer is yes, we do have confidence in those names. I think what happened is that the market completely misinterpreted the regulatory measures that were being introduced around the education sector and extrapolated that to a lot of other sectors and to a lot of other companies. And that means that there was a lot of fear that the government wanted to limit corporations, limit for-profit corporations, maybe even nationalize some of them, and also restrict foreign capital and foreign investment and potentially even go one step further and impair the foreign capital that's already been invested in those companies. But that's just not the case. In fact, those regulatory measures around the education sector were just the tools that were being used to affect the desired outcomes and the decisions that the government had made. On the other hand, there's sectors of the economy like e-commerce, the internet sector, software, electric vehicles, artificial intelligence, automation, that are that are encouraged and supported by the government because they're in line with helping the CCP achieve social sustainability, but also economic development and technological process over time. And I think that Alibaba and Tencent are two companies that are operating in a number of those sectors, and they're operating notwithstanding their own relationships with the government and some penalties earlier in the year. They're actually operating in support of the CCP's ambitions and goals and being encouraged by them. And so they're on the right side of the Chinese government's plans, and the education sector was on the wrong side of that. And so there's a lot of reasons to believe that in the long term, Alibaba and Tencent are still going to do very, very well.
Okay, great. And so but I guess it's fair to say there's a lot of risks and uncertainty associated with owning these Chinese tech names. And have you thought about, or why would you not just own the Western names like the Facebooks and Microsofts of the world?
When we do own Facebooks and the Microsoft specifically of the world, but there's still an enormous opportunity in China. That's an economy of over 1 billion people, growing still at 6% per annum. And there's a massive digital economy there as well. And Alibaba and Tencent specifically are in a privileged position to benefit from that over a long period of time. Both of them have more than 1 billion users. Alibaba facilitates over $1 trillion of commerce transactions on its platforms every year, and still, e-commerce, for example, in China is only 30% penetrated, but it's growing at 30% year in, year out. And Alibaba's e-commerce platform is the dominant e-commerce platform in the space. And then away from that, some of the more nascent businesses that Alibaba owns include a cloud business, which is growing at 40 to 50% per year, which is going to be instrumental in the digital transformation of enterprises and businesses and consumers in China for decades to come. So there's still an enormous population, an enormous economy that's growing very quickly. And within that there are some amazing and really powerful transformations going on. And Alibaba and Tencent are really well positioned. They've cemented themselves as the leaders very early on in those large and accelerating markets. And so they still provide wonderful opportunities for us to make money over time. And I think, to add to that, something that's really important is that it's not being recognized in the share price today, especially after the recent sell-off. So you've seen the value of Tencent and Alibaba pull back, and we think that there's a tremendous opportunity there. Markets never like uncertainty. And with these regulatory uncertainties, what's being forgotten is the fundamental upside over time. And just to give you an example there, if you look at, take Alibaba and the valuation, I think there's still a wonderful story around e-commerce, obviously, but you're also getting the tremendous value uplift in cloud computing for free. That's being under-recognized. And there are other businesses there, like their e-commerce platform in Southeast Asia, that's doubling year in, year out, that are just not being accounted for in the current stock price. And then, speaking to the analyst team in New York just yesterday, and we were running through the valuation of Tencent. And Tencent has $200 billion of investments all around the world, including in Spotify and Epic Games and a host of other global names. If you remove those investments, and look at what the business is being valued at, it's only at around 13 times price to earnings. And so there's these businesses are still remarkably cheap on the stock market, and we think that they represent incredible value over time.
Okay, great. thank you very much for your time today, Chris. And obviously, if anybody has any other questions, please do feel free to come through and ask them.
Thank you.